Let's be honest about something most financial advice refuses to say out loud. The average person doesn't lose money because they're stupid. They lose it because they're human. And being human means we want results now, we trust what's familiar, and we panic when the numbers turn red. For the next 8 minutes, we're going to talk about investing the way it actually works, not the way it's sold on social media, and not the way it's dramatized in movies. This isn't about getting rich overnight. It's about building a system that survives your own emotions, your busy schedule, and the chaos of the real world. By the end, you'll have a clear framework for making decisions that your future self will genuinely thank you for, not because you got lucky, but because you built something steady. Let's start with a question that sounds simple, but isn't. Why do most people fail at investing? It's not because they picked the wrong stock. It's not because they started too late. It's because they never defined what the money was actually for. Think about it. If you don't know what you're saving for, every decision becomes a guess. You buy something because it's going up, you sell because it's going down. You're not investing, you're reacting. And reacting is expensive. So before we talk about portfolios, index funds, or compound interest, we need to talk about goals. Not vague goals like I want to be rich. Real goals. Specific ones. A down payment on a home in 7 years. A child's education fund that starts in 10. A retirement that doesn't depend on winning the lottery or inheriting from a relative you don't have. Here's the thing about specific goals. They change your behavior. When you know you need a certain amount of money by a certain date, you stop asking what's hot right now and start asking what gives me the highest probability of getting there. That shift from chasing excitement to managing probability is the single biggest mental upgrade you can make as an investor. Now, once you have a goal, you need a plan. And a plan isn't a wish, it's a budget. I know the word budget sounds restrictive, like a diet for your wallet. But here's a better way to think about it. A budget is just your priorities made visible. If you say you care about your future, but you're spending more on subscriptions than on savings, your budget is telling you the truth. And truth, even when it's uncomfortable, is useful. The goal isn't to live like a monk. It's to make sure the money you're keeping is working towards something you actually want. That might mean cutting a few things. It might mean saying no to some short-term fun. But every time you do that, you're not losing something. You're buying future freedom. You're paying yourself first. Let's talk about what happens after you've started saving. You've got some money set aside. Now what? This is where a lot of people freeze. They're afraid of making the wrong choice, so they make no choice at all. They leave their money in a checking account, earning almost nothing, while inflation quietly eats away at its value. That's not safe. That's just slow loss. The alternative isn't gambling on crypto or day trading. The alternative is diversification. That word gets thrown around a lot, but let's break it down. Diversification means you don't put all your eggs in one basket, but more importantly, it means you don't put all your eggs in baskets that are likely to break at the same time. Stocks give you growth potential. Bonds give you stability. Real estate gives you income and a hedge against inflation. Cash gives you flexibility. Each of these assets behaves differently under different conditions. When stocks are down, bonds might be up. When real estate is slow, cash lets you take advantage of opportunities. By combining them, you're not trying to predict the future. You're preparing for multiple futures. And here's where I want to make a point that might surprise you. You don't need to be brilliant to invest well. You need to be consistent. The most powerful tool most people have access to isn't a hot tip or a secret strategy. It's a low-cost index fund or ETF. These are essentially baskets of many companies giving you broad market exposure with minimal fees. They don't require you to pick winners. They just let you own a piece of the entire economy and ride its long-term growth. Warren Buffett, one of the most successful investors in history, has repeatedly said that for most people, the best investment is a low-cost index fund. Not because it's exciting, because it works. It's the financial equivalent of eating vegetables and sleeping 8 hours. Boring, but effective. Now, let's talk about the part that trips up almost everyone: emotions. You can have the perfect portfolio, the perfect plan, and the perfect budget, and still fail because you can't handle watching your balance drop. Here's a hard truth. If you invest in anything that has growth potential, it will go down sometimes. Not maybe, not if, sometimes. That's the price of admission. The problem is, our brains are wired to feel losses more intensely than gains. A 10% drop feels twice as bad as a 10% gain feels good. That asymmetry is why people sell at the bottom and buy at the top. They're not making rational decisions. They're making emotional ones. And the market is very good at punishing emotional decisions. So what do? You automate. You set up automatic transfers from your paycheck to your investment account. You set up automatic contributions to your index fund. You make investing a default, not a decision. When it's automatic, you don't have to be strong every month. You don't have to talk yourself into it. It just happens. And over time, that consistency compounds, not just your money, but your discipline. Let's talk about compound interest for a moment, because it's the most misunderstood concept in personal finance. People hear compound interest and think it means save money and it grows. That's true, but it's incomplete. Compound interest is about time. It's about giving your money enough years to generate returns and then having those returns generate their own returns. It's exponential growth. And exponential growth is slow at first, then sudden. Here's a way to think about it. If you invest $100 a month starting at age 25, and you earn an average of 7% a year, by age 65, you'll have over $260,000. But here's the kicker. You only contributed $48,000. The rest, over $200,000, is the market's gift for your patience. Now imagine you start at 35 instead. Same $100 a month, same return. By 65, you'll have about $120,000. Half the result for the same effort just because you started 10 years later. That's the power of time. And it's why the best time to start was years ago. The second best time is today. But let's be realistic. Not everyone has $100 a month to spare. And that's okay. The amount matters less than the habit. Even $20 a month, invested consistently, builds the muscle. It teaches you to think like an owner, not a spender. And as your income grows, you can increase your contributions. The habit is the foundation. The amount is just the building. Now, let's address something that doesn't get talked about enough: rebalancing. Over time, your portfolio will drift. If stocks do well, they'll become a bigger percentage of your portfolio than you intended. That sounds good, but it also means you're taking on more risk than you planned. Rebalancing means bringing it back to your target. You sell a little of what's grown and buy a little of what hasn't. It's counterintuitive. You're selling winners and buying losers, but it forces you to buy low and sell high systematically. Not because you're smart, but because you have rules. And that's really what this whole thing is about. Not being smart. Having rules. Rules that protect you from your own impulses. Rules that keep you on track when the news is scary or exciting. Rules that turn investing from a hobby into a system. Let's talk about information. Because we live in an age of constant noise. Financial news is designed to make you feel like you need to act. Every day there's a new crisis or a new opportunity. But here's the reality. Most of that news is irrelevant to your long-term plan. The market goes up and down in the short term for reasons that are often random. Trying to react to every headline is like trying to steer a ship by watching the waves instead of the stars. That doesn't mean you should ignore the world. It means you should filter it. Ask yourself, does this information change my goals? Does it change my timeline? Does it change my risk tolerance? If the answer is no, let it go. You don't need to have an opinion on everything. You need to have a plan for your own life. And speaking of learning, never stop. Financial literacy is not a course you take once and you're done. It's a skill you build over time. Read books, listen to thoughtful podcasts, learn about taxes, about estate planning, about how different accounts work. You don't need to become a professional. You just need to know enough to make informed decisions and to recognize when you need help. There's a phrase that gets repeated in investing circles. Time in the market beats timing the market. It's true, but it's also incomplete. The full version is time in the market combined with consistency, diversification, and emotional control beats timing the market. The people who win are not the ones who predict the future. They're the ones who prepare for it. So let's come back to where we started. Why do most people fail at investing? Because they treat it like a game of prediction. They want to know what's going to go up next. They want certainty. But investing isn't about certainty. It's about probability. It's about stacking the odds in your favor and then giving yourself enough time for the odds to play out. You don't need to be lucky. You need to be steady. You need to define your goals, build a budget that honors them, diversify across assets, automate your contributions, ignore the noise, and rebalance when necessary. And above all, you need to be patient, not passive patient. There's a difference. Passive means you're not paying attention. Patient means you're paying attention, but you're not letting short-term events derail your long-term plan. Your future self isn't a different person. It's you with more experience and less time. And that version of you is watching the decisions you make today. Not with judgment, but with hope. Hoping that you're the kind of person who builds rather than chases, who plans rather than panics, who understands that wealth isn't a destination, it's a direction. Start smart, stay steady, and let your money do what it's supposed to do. Work for you while you live your life. If this perspective resonated with you, there's more where that came from. We dig into topics like this every week. Not hype, not shortcuts, but the kind of thinking that actually builds long-term results. So if you want to keep learning, consider subscribing. It's a small action today that your future self will appreciate. Just like investing.